Hey, this is Sasha. Thanks for joining me in today's video. And what I want to share with you today is really why many people fail when it comes to buying single put options or single calls. Really, it gives options a bad rap when in fact people just don't understand what they're doing. So stay tuned. I'll share with you some insight in this video. All right, so one of the reasons I'm doing this is because we do have a new course coming out, which is just on the basics. So that's why this video is going to be focused on the basics. It's called Options Foundation. This is version 2.0, so the whole course got reworked start to finish. It is now 11 hours long. For that 11 hours, if you go to our website at tradersfly.com, you could go ahead and check it out and then go to courses, or just right there on the homepage, you'll be able to see it. Click and learn more. So 11 hours, really in depth and detailed, and you can save $50 as well before Christmas time. So feel free to check out that course. We've already released it in parts. So for example, November 25th, we've released a bunch of these videos. Then we're going to release the next batch, which we've already done, and now December 9th. So all of these are getting released periodically, and if we're missing a section, we will add it in. So check that course out. Now, without further ado, I'm going to share with you some insight on why many traders fail when it comes to buying single put and call options, and a lot of this has to do with some of the things that we'll cover in the course as well. So so a lot of people, they go ahead and they get into trading options, and they think what they normally transition from is people are transitioning from a stock equivalent. So they understand how stocks work in a basic principle of, hey, I buy a stock at a lower price, just like, hey, if you buy a video game at $30 and you sell it to your friend for $35, if I buy a stock for $20 and I sell it for $22, now I just do that 10 times with 10 shares. They try to do that same concept when it comes to options, and it starts to overlap. And because people go from their previous knowledge, they go from past behavior of understanding of what they use in stocks, they go ahead and try to apply that to options. So when we go ahead and do this, let's just say we're going to go ahead and take a look at, I'll just do, let's go with Square real quick, just because it's a cheaper stock to trade. So if we go with Square right now and we try to go ahead and buy this stock, you might go into 5-minute, 15-minute, it doesn't really matter. But let's say, hey, it's going down and we'll still buy a call option. So let's just go ahead and buy a call option. And I go to Square and I choose a call option. I might go here, let's go to a 22-day call option. I'm just going to pick one here real quick. And this is what a typical approach is people go in, they look at it, they look at this call option, and they say, okay, well, I want to go ahead and buy this call option. You might do it, 3 or 4 or 5 times. It costs you $2,000. Here's $920. So here's a $1,000 trade. You go ahead, you put it in, and boom, you're filled. So now you're waiting for the stock to go up. You're waiting, you're waiting, you're waiting. The problem, what most people encounter is that they go ahead, and whether they do this on the call side, or let's just take a look at another one. Let's go with PayPal, maybe the competitor, PayPal. And here what we'll do is we'll get some put options. So you might be thinking directionally. Again, I'm not going to look at the chart or really evaluate it too much. We're just going to, hey, check this out. It's kind of moving. Let's say this is kind of going on the downhill. And we'll buy a put. So we'll go ahead and buy some single puts. We'll go ahead and get 4 contracts here. Boom, there we are. We've got our calls, we've got our puts. Here is our Square position. So what do we have? Right here, down about $45. Here's PayPal, right there, down $48. So as we look to these trades right now, and we check this out, what a lot of people don't get is that trading options is a whole different world and ball game than trading stocks. You typically don't do things like this directionally. Can you do it? Yes, but there's a lot of situations where there's better strategies set up with options, because you have to account for additional factors. For example, if I just went ahead and let's say I bought the stock here, and I bought, let's say, 100 shares of Square, that purchase is very directly tied to the price. So that price, as it moves up or down, it's directly tied. And that is because, hey, this is the delta, this is your risk, this is how you make your money. There is no gamma, no theta, no vega. So it is directly tied to this delta. I bought it at a certain rate right here. Let's just say 115. Okay, there was my price. Exactly 115. Wow, that's rare. So anyway, and now as it moves up or down, I make money, okay, or lose money. And it's directly tied to the price. The problem is when you get into options, your profits and loss now are not directly tied to the price. They are somewhat tied to the price. They are in part tied to the price, but it's not everything, because there's different components that make up the value of an option. Because remember, when you're selling a stock, you have this one entity or one thing, right? If I go ahead and now try and sell you, let's say this Sharpie, this is one entity, this is one thing, and it's directly tied. If I bought it for $1 and I go to school and I sell it for $1.25, it's directly tied, okay, to this component. Now, when we deal with options, the issue that most people don't get is that it's not directly tied to the price itself. The value is driven from multiple factors. So here, what happens is as we look to the delta, yes, we do make money from delta or price, but there's other components here as well where we can make or lose money. And this is what people don't get, is that we have a time component that's very big, and we have a vega component that's pretty big. Yes, your price component, which is your delta, it is the biggest one, and this is why you've probably chosen a direction for it to go up. Or maybe you went ahead and, let's look at PayPal really quick. You might have chosen this component because of the delta. Let me go ahead and delete these other slices. You might have chosen this because the delta of that component for it to go down, because these are put options. But you still have other components that dictate the value at the end of the day. So that's what's important that you have to recognize, is that you still have a theta and a vega. And when you start dealing with this and you don't understand, well, why is there a vega? What makes this option contract, the value of it, go up and down? If you don't get that part, this is why a lot of people lose in single directional options, is because, number one, I guess the first thing is probably the theta. They don't get that when you hold on to this position every single day, just take a look. If I move a hypothetical day right here, this day, forward, I'm going to lose an extra $45 on top of what I've already lost. So add 45 right now to 49. Watch what's going to happen. Look at that. Now I'm down 96. Add an extra day. Now I'm down 142. So now, just to get back to even, I have to make up that $142. And this is what people don't understand. And this is the problem with dealing with single option contracts when you don't understand what you're doing. Can you still do this type of trading? Yes, you can. It's not that you can't do this. It's just that you probably wouldn't, let's say, invest 100% of your money doing it this way, because you're just losing time value all the time. So every single second, in a way, you're losing that time value and premium. And if we go back to Square, it's no different. So here is Square. We have these components, and we're losing, in this case, $25. So go ahead and deduct 25 from 64, and you'll know what's going to happen the next day. You're going to be down 90. Next day, you'll be down 116. And the reason you start at 64 is the bid-ask spread. So you're already starting down in the same way that you might with a stock, but because with a stock it's directly tied, you don't have as big of a bid-ask spread, and you've got other components. So this is kind of the first big issue that people don't get, is that the time value works against you when you're a buyer of these kinds of option contracts. And people try to trade these things directionally, and then they're like, oh, okay, well, I'm starting down in a big way already. But even if this thing does go up, sometimes it can work against you, because the time value and the volatility value works against you in different ways, depending on what you're doing. So here's Square and here's PayPal. And, you know, what's going to happen, what's interesting, is they're both positive vega. So take a look at this vega. Here's another little issue that you may not think about. And here's this one. This one's a positive vega. But look at this. Think about it this way. You want this stock to go up, right? But you've bought a call contract that's positive vega. Well, just as a little tip and bonus tip, well, what happens as stock price goes up? Volatility goes down. And let's say it goes down 2 points. Well, look what happens to your profit and loss. Look at our profit and loss right here. So this is just a little bonus, and I'll do a video exactly on this. Right here, and it goes down 2 or 3 points, -3. Watch what happens to your profit and loss, and look what happens to this graph, okay? Because we'll take out the volatility. Boom, you're actually gonna be down even more. So you need even more movement to the upside. And this is why you have a very strong delta, and you're hoping that the delta will offset it. But in other words, if you're buying call contracts and you're thinking, hey, I'm gonna go ahead and make money from them from a directional basis, it's not the smartest approach. Anyway, you got other factors that tie into making or losing money in the world of buying single contracts. Whether you're buying a put or you're buying a call, you have to understand the time value and you have to understand the volatility value on top of the delta. That's where money's coming from. You got delta, gamma, theta, vega, and rho. These are the main factors. And most of the ones that we focus on is kind of delta, theta, vega, and price is, of course, the key. And this is why most people, they deal with the price because they want price movement because they come from the stock background. But with options, you got to take into account the time and the volatility. And sometimes your vega is way bigger than even your theta or your delta. So that's even more important. All right, so there you go. I hope you join me in the course and go ahead and check it out. So if you're interested in taking your options to another step or you're just getting started with options, this is a great course to get started with. It's the second version. So I started with the DVDs 3 hours long. Now it's 11 hours long, way more detailed, a lot of different examples. Just the technology is there now to be able to film a lot more and in more detail, more crisp the way I wanted to. So go in, check it out, tradersfly.com. I hope you join me in the course. It's really a good deal when it comes down to 11 training hours, 11 educational hours for about $300 or so. And, that makes it a good deal, especially if you get it before Christmas. We've got some other great things coming soon for technical analysis for options traders. And we also released a butterfly course not too long ago, which is like 20 hours long. So stay tuned. I'm going to share with you other great videos for free. If you are not interested in the course, that's totally okay. Just subscribe to the YouTube channel so you get notified when other things are released, or get on the newsletter list and get some of the freebies that I have available as well. Thanks for joining me. And remember, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you in the next video.